let's take a look at what's going on today. Your reaction first to the oil inventory report. What do the supply fundamentals look like right now?
There's a lot of oil around. We're absolutely swimming in crude in the U.S., but there's a lot of dynamics today. It's a very volatile market, and some things have actually caused prices to bounce rather than react really to the crude inventory build. So we have a weaker dollar. In the physical markets, gasoline is strong. Some of the other physical crude grades, such as LLS on the Gulf Coast, are strong. And you also have things like Yemen, and anytime you see headlines that, the Saudis are massing troops on the border, something like that, even though we don't think anything is imminent there.
And the president leaving the country.
Exactly, and that gets the market very twitchy.
How desperate is the market to store oil right now?
Well, Cushing is very tight and is getting very full. So there's definitely an issue there, and it could get worse in the coming weeks. And that's why we're seeing, again, with the exception of days like today, big picture, we do expect for the next 2 to 4 weeks that we see continuing pressure on the front of the WTI curve.
Mike, there's no uniform standard on tank space. The EIA does not quantify it. Since operators, they are at liberty to set their own levels of contingency. Do we really know how close to full we are?
Well, actually, the EIA does put out some pretty good numbers just twice a year. I mean, they don't update it every week or every month, but if you look at what they're saying, there's actually a fair amount of crude in the U.S., of space for storing crude in the U.S. outside of Cushing. So, again, and you can say the same thing pretty much for the rest of the world. So Cushing, there's an issue, but we don't actually think that we're really imminently bumping up against constraints in the rest of the world or in the rest of the U.S.
Your colleague, Alain Bacosba, is Societe Generale's head of strategy and global asset allocation. He said in a report this week the next few months will be, in his words, detrimental for oil. How so?
Well, big picture, in the second quarter, we expect huge global stock builds to the tune of 1.9 million barrels a day. And that's bearish any way you slice it, whether it's in the U.S. or Europe or Asia, whether it's crude or products, onshore, offshore, any way you slice it, it's a big number, and that's going to be bearish. But in the coming weeks, I think the worst of the downward pressure starts to shift from WTI over to Brent, because in the U.S., remember, we're almost out of refinery maintenance season, so crude runs, refinery demand, in other words, starts to go up in April. So that's why I think the pressure actually starts to shift over to Brent.
Oil is down 11% from this year's peak in February. What's that going to mean for OPEC when it meets in June?
I don't think it means anything for OPEC. I think OPEC stays the course. I think Saudi Arabia and their, Gulf Arab allies are just going to let this thing continue. In other words, let the market set the price, and they're not going to actively try to manage supply.
Speaking of supply, the rise in production, how is this making the global supply glut worse?
Well, because the guts of the issue is U.S. shale oil, as you know, and really we've seen no impact on shale production despite rig counts being down by almost half.
You surprised by that? The rig count down by that much, and there doesn't seem to be any interruption?
Well, we knew there was going to be a time lag. I'm a little surprised stepping back and how long it's taken, but there's actually something in today's report which is interesting. Week-to-week production for the lower 48 states in the U.S., which of course is where shale oil is, it's actually flat. And some of the reports that the EIA is starting to put out is showing that we're just a month or two away from month-on-month declines in shale oil. So it's been a very long time, and the market has been kind of antsy waiting for that, but I think we're about to see it start to turn down.
How does the strong U.S. dollar factor into what we're seeing in the oil market, particularly the volatility?
It's a factor on any, again, big picture, it's more about the oil fundamentals. I think the dollar's secondary. Okay. However, on any given day, and today's a perfect example, it can be a big market mover. So it's something that we need to keep an eye on. And so you have to think about U.S. and the liftoff of rates and that whole story.
Okay, all of this being said, what does this mean bottom line for the U.S. consumer?
The U.S. consumer, the end user, both individuals and businesses, I think are going to continue to see, compared to what we saw in the last 3-4 years, pretty low prices. I think the low point is the second quarter, and we start to see some moderate uplift in the second half, but nothing crazy. In other words, 45 WTI in the second quarter, going up to 50, 54 in the next 2 quarters of the year. So